Hey, this is Mike, and today I want to do a video on how to build a stable investment portfolio. And I'd like to thank Base Sleep, who commented on my video, When to Buy Stocks, for recommending this video. And I think it's a great idea for people who may be a little nervous about all the big up and down movements in the stock market, and they just want to put their money away and put in something that's stable so it doesn't move up and down too violently, but it consistently makes you money year after year. So this is going to be the video for you. So the goal of a stable investment portfolio is a portfolio that will reduce your volatility. So you don't have to worry if there's, you get a lot of doom and gloomers who say there's going to be a big crash in the market, whatever. When you have a portfolio like this, you don't even have to worry about it. You can sleep like a baby. And it's a great strategy idea. Let's say if you're retired and you just need money to generate income. In fact, this is a strategy I will probably use when I retire, if I retire, whatever, just to have my money put away and just know that I can get a decent return over time. So you do want to get nice returns here because there are stable strategies out there that can return you next to nothing. If you put all your money in just like short-term treasuries, yeah, you could, or CDs, yeah, you could get a return that's stable, but it'd be like a 1 or 2% of your return, especially in these low interest rate market environments. That's not going to be very good. So what you want to do is follow Harry Brown. Harry Brown is a person who invented something called the permanent portfolio strategy. And this is a strategy that's designed to perform well in any environment. It's a very simple and straightforward strategy. His strategy is basically to divide up your portfolio in 4 non-correlated asset classes. And these 4 non-correlated asset classes include putting 25% of your money in stock, 25% of your money in gold, 25% of your money in long-term treasuries, and 25% of your money in T-bills, or what's basically a cash equivalent. So the good news about this kind of strategy is that you can literally use 4 ETFs to create your own permanent portfolio. And I'm going to show you the ETFs. And the great thing is this strategy, and I'll show you later because I'm going to show you a back test of the permanent portfolio. I'll show you that like it's up years and down years. So here are the 4 ETFs that you can use to do the permanent portfolio strategy. To get your stocks, your 25% of stocks, you use VTI, and this is the Vanguard Total Stock Fund. So it takes all the stocks that are out there and puts them in one fund, and that's VTI. The gold ETF is GLD. They basically hold contracts, futures contracts that are the equivalent of gold. It's a very stable fund. It's the largest gold ETF in the world. For your long-term treasuries, TLT, and for your T-bills or short-term treasuries, BIL. You will put equal amounts of money in each of 4 of these ETFs. So, for instance, if you have $10,000, you would put $2,500 in each 4 of these ETFs. Now, to demonstrate the stability and the growth of the permanent portfolio, I did a back test. This is a great website if you don't know about called portfoliovisualizer.com. And on the homepage, they have something called the Backtest Portfolio Asset Allocation. And basically what you can do here is you can put the years you want to start and end the back test, the initial amount of capital, and you could also compare your portfolio against a benchmark. So for the benchmark, I put the Vanguard 500 Index Investor, which is basically the S&P 500. And I went ahead and I put in equal weight amount in VTI, GLD, TLT, and BIL. And the system was able to go back as far as 2008 because that's when all these ETFs were available. So this is a 12 to 13 year back test. And as you can see, there's an equal 25% allocation on each of these ETFs. And here's the overall performance. There's a chart below for more information. But in 13 years, if you had put $10,000 basically in the S&P 500, you would have gotten $29,500 with an annualized rate of return of 8.87%. If you had put $10,000 in the permanent portfolio, you would have gotten back $22,962 with an average annualized rate of return of 6.74%. So you do get less money than putting your money in the S&P 500, but you're going to see you get a lot more stability. So for instance, the best year in the S&P 500 was 32% return. The best year in the permanent portfolio was 16%. However, look at the worst year for the S&P 500, you're down 37%. The permanent portfolio, you're only down 3%. The biggest drawdown from putting your money in the S&P 500, 48%. That's almost 50%. The biggest drawdown in the permanent portfolio, 12%. If you're retired, you can definitely live with having a 3% down year and a 12% maximum drawdown. So let's go ahead and take a look at the chart. And what you'll notice here, the red line is the S&P 500. So you notice the S&P 500 during 2008 had that big dip. So if you start out with $10,000 in the beginning of 2008, by February 2009, you have lost half your money. You would have had a heart attack if that was your retirement money. Of course, the S&P 500 did recover, and it does end up getting some incredible performance. But look over here when we had the pandemic crash. Look at that crash that we had here. That would have given you another heart attack if you were retired, and you would have been 12 years older. So that heart attack would have been even worse than the first one. Of course, the S&P recovered. But now pay attention to the blue line here. Notice the stable growth of that blue line as it goes from $10,000 to almost $23,000. That's really what you want if you want some stability. And I'll show you the year of returns. Now the red bars are the S&P 500, the blue bars are the permanent portfolio. And you'll notice like the big down year in 2008, the S&P 500 was down 37%. The permanent portfolio was up less than 1%. And of course 2009 was a big year for the S&P 500, which was up 26%. The permanent portfolio was up 7%. So you see this annualized return. If you look at the blue bar, yeah, you get a couple of down years, but the down years in the permanent portfolio aren't so bad. You have down 2%, down 3%, down 1.76%. That's pretty good. And when you're up 6 to 7%. So overall, the permanent portfolio is a great strategy if you want stability plus growth. And that's the important part, because when you are retired, you want to get some money in. So let's say, for instance, this is an almost 7% return. If you have $100,000, or let's say $1 million saved up at 65 years old, you save up $1 million, you retire, you put your money in the permanent portfolio, with an average rate of return 6.74%, that gives you, if you have $1 million in a permanent portfolio, you get about $67,000 a year in returns. And then, you could live on whatever, $5,000 a month plus your Social Security. That's a pretty good rate of return, and plus you don't have to worry about your retirement money being cut in half. So definitely take a look at the permanent portfolio. If you want to know more about it, you could do like a Google search or YouTube search of Harry Brown, because he's the person who created this strategy, and there's a lot of insights on it. So definitely recommend you take a look at the permanent portfolio strategy. I hope you enjoyed this video. If you did, do me a favor and leave a like, and if you want, go ahead and subscribe, because I do breaking news on stocks, and I also do occasional educational videos about how to buy and sell stocks, different portfolios, back-tested strategies, and the such. Okay, thank you very much. Bye.